What's up, everybody? Right before we get into the show here, just want to give a quick shout out for our next Blockworks conference coming up in just over a month. Permissionless 4 is happening June 24th to 26th, and it's a crypto conference all for the developers and builders in the space. We're going to be hosting it right in the heart of Brooklyn, New York, and it's going to be a ton of fun. There's going to be a lot of fantastic speakers, and the whole Forward Guidance crew is going to be there. Myself, Tyler, Quinn, we're going to be doing a live roundup. There's going to be some wicked community events. Come meet us, have a beer with us. Come see some of the awesome side events, some fantastic speakers. There's new ones being announced every single day. So go ahead and get your tickets. Use the code FG10 to get 10% off and don't miss out. This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. Visit blockdaemon.com to get started or book a call with their team today. Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed.
We all have TDS. It's just what degree do we have it? So whether it's the loss of American exceptionalism, which is an insulting statement on its own, that's only really been coined by a bunch of salty Europeans, or whether or not it's now taco or it's the soft data or whatever it is. I think people want things to go bad because they want to blame Trump. They want something to blame Trump about.
I think, okay, so I just had to hit record there. Jim Bianco and I are here on Forward Guidance, and literally within 10 seconds, we just got straight into it. And the theme at hand is that people are completely off guard and just can't come to terms with the economy as it stands today. And yeah, like we've talked on conferences before. We've talked many times. I've heard you in tons of podcasts since like 2021 talking about how the economy has changed now permanently, and people can't come to terms with it.
You know, you said it too nicely. What I said off camera 5 seconds ago is everybody's gotten it fucking wrong. You know, it's just been completely off base is what they've been talking about. And just to bring the crowd up to speed here, we just got the job opening labor turnover report for April, the JOLTS report. The headline number in the JOLTS report is the number of open jobs in the country. It went up from 7.1 million open jobs to 7.39 million open jobs. In April, it went up. April was the month that the smartest and best people told me the soft data is collapsing. That's a leading indicator. The economy's going into recession. Polymarket said 65% chance of a recession. The stock market corrected 20%. We got Liberation Day. All that happened in April. And we were told bad things were coming. What were companies doing in April? They were filling out help wanted advertisings to get more people in the door. We couldn't have if we had a meeting and said, how do we embarrass the hell out of ourselves by getting everything wrong? That was April. Nothing that we said about April has now looked like it's come to pass. It's been exactly the opposite. The economy picked up. You know, the GDP now number is at 4.6% for the second quarter, which started, by the way, April 1st. That now we're seeing that job openings picked up in the month of April. We had a beat on payrolls for April. That was a month ago. We're going to get the May number at the end of the week we're recording. So we really got to sit back and say, this economy is just not performing the way people think it is supposed to perform. And what you said is right. I've been arguing that every time there's a recession and or a financial crisis, and we had both, the economy changes. It is changed. It is changed, and everybody's got their 2019 playbook, and they keep running it out there, and it doesn't work, and it doesn't work, and it doesn't work. And April is the latest example of that.
100%. I mean, even back then, that Q1 GDP print, the only reason it was negative was import front running. And a lot of that was gold. And in reality, like, consumption was solid. Investment surged that month. And then now here we are again. And yeah, we're seeing obviously a lot of that whipsaw on that GDP now print right now that we're seeing above 4 is because of the imports that are reversing the other side of things. But beneath that, there's also still a very strong consumer. So overall, like let's just hit it over people's head here a little bit and try and diagnose this a little bit. It feels like to me there's two issues at hand. There's the one side of things, which is people are misdiagnosing the fundamentals of what drives the economy in this era of just huge fiscal deficits and overweighting this obsession with the Fed and what monetary policy is doing. So that feels like one side of things. And then the other side is this more vibes-based, sentiment-based discussion that you just mentioned, which is what we see in the survey data, which is that people keep feeling like the vibes are bad, but then the economic fundamentals remain so good. So let's just try and diagnose this a little bit more and see if you repeat it 20 times here, the 20th first time will be the time that it actually sticks with people. So yeah, like tell it like it is, Jim.
Yeah, no, I agree with you. I mean, as far as I'll take the vibes part first. You know, I love Kara Scanlon, and she does great work. She's coined the vibe session. There is no such thing. I'm sorry, there really is no such thing as a vibe session. And as far as the soft data goes, I mean, even in April, I was kind of saying this, but I was kind of yelling into a vacuum. Nobody was listening. I said, soft data, the survey data, people's opinions, it's a lagging indicator. It's not a leading indicator. If first the real economy moves, how many people get jobs, how many people are buying things, how much stuff is imported to the country or exported to the country, what is the inflation rate? And then the soft data reacts to that. It's always been a lagging indicator. It has not been a leading indicator. What I think has happened in the last few months is we've all become overly narrative driven, and we all want to have narratives. And we have a polarizing president, whether you like him or you hate him. We have a polarizing president who drives nothing but narratives. And so we all latch on to all of these narratives that he seems to drive, and we overdo everything. And right now, we're overdoing all of the bad stuff in the economy. First, it was the soft data. Now it's taco. It was the import numbers. It was the deal with the Chinese, or off again, on again with everything. We overdo it. But what's happening in the real economy? Most of this is being ignored. Most of it is being ignored, which accounts for why the stock market's recovering. Because slowly and surely, everybody is starting to realize they bought into a bad narrative in the stock market. And to push that narrative, to get to the first part of your question about over-reliance on the Fed, have you noticed that there's only one question that everybody asks? When is the Fed going to cut rates?
When rate cuts.
Never, ever ask the question, do they ever need to cut rates again? Or maybe they should raise rates. No. Because we've got our models from 2019 and 2018 and pre-COVID. Here's the way the economy worked pre-COVID. There was no inflation. But we have inflation at a 4-year low right now. Yeah, but it's still higher than anything we saw between 2010 and 2020, even though it's at a 4-year low. Still higher than anything between 2010 and 2020. But we've decided there is no inflation. The Fed has to cut rates. It doesn't have to cut rates. It doesn't have, the rate cut cycle, first of all, from September to December was unnecessary. The bond market told you it was unnecessary because 10-year yields went from 360 to 480 in 5 months while the Fed was raising rates. I know the Fed doesn't like it, but I'm sorry, Jay Powell, that was a rejection of the policy. It was saying we didn't need you to stimulate. We were more worried about inflation. And if you want to stimulate by cutting rates, we're going to sell your bonds. Now, I get it. Trump is a real estate guy and he wants the Fed to cut rates. My theory on why Trump hates Powell, by the way, goes back to 2018. In 2018, somebody told Trump during Trump 1.0, they have negative interest rates in Europe. And he said, what does that mean? That means when you take out a loan for one of your buildings, the bank pays you a monthly payment. And Trump said, what a great idea. Why don't we have them here? And then they said, well, Jay Powell doesn't like them. And from then on, he's hated Jay Powell. It said he wants to refinance all his Trump towers with a negative mortgage. And Jay Powell won't let him have one. And so, but I think what we need to understand is since 2020, with that cycle change, even though what you might hear me saying is the economy's doing well, the economy's doing well, the economy's doing well. What's the hitch? The hitch is inflation. The hitch is that we have stickier, higher inflation, and that breeds higher interest rates. So I'll get to another narrative for you here. Bill Dudley wrote this in a piece the day before we were recording on down. Everybody's looking at a 5% 30-year and saying, what's wrong with the bond market? Why are interest rates so high? And they're gravitating around the new narrative that it's about the big, beautiful bill, doesn't cut enough spending, has too much borrowing, has too big a deficit. Now, I agree with that part. It does. But the other part I'll push back on is, how about this? 5% yields are normal. That's where they should be right now. We shouldn't be torturing ourselves to talk about what's wrong with the bond market. The answer is nothing. This is the world we are in now. We are in a 5% world. The big, beautiful bill, the fear is it will produce a 6% world or maybe higher. And that would be problematic. Look at what the stock market's doing. It is recovering. It is telling you 5% rates are not a problem. If the Fed were to cut rates in this environment, I think what you'd probably see is 6% rates, just like you saw last September. So that's another narrative too that I think we need to get ourselves around. Everybody's still trying to, the implicit thing. I saw a thing on Twitter a couple hours before we were talking. Somebody overlaid like the number of stories mentioning the big beautiful bill with interest rates, and they go up and down. The implication there is, see, there's something wrong with the bond market, and it's the Washington bill that's causing something to be wrong with the bond market. I'm saying there's nothing wrong with the bond market. It's where it should be. And the last thought I would give you is if you look at the MOVE index, that's like the VIX of the bond market, the Merrill Option Volatility Estimate. It's at a 3-month low. There's no stress in the bond market right now. And the stress is people stuck with 2019 mentalities trying to understand why we're at 5%. And the answer is, if you're stuck with a 2019 mentality, you can't understand why we're at 5%. But if you start to think about that this is a post-COVID economy, things have changed, inflation's a little stickier, then it starts to make a little bit more sense, but not enough people are thinking that way.
If you're building anything in crypto or institutional finance, you need to know about Blockdaemon. They've been powering blockchain infrastructure since 2017 and are now securing over $100 billion in digital assets for more than 400 institutions. From institutional staking and node infrastructure to MPC wallets and APIs, Blockdaemon is the go-to partner for performance, scale, and security. Learn more at blockdaemon.com. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. This episode is sponsored by Arkham, a crypto exchange and analytics platform that lets traders and investors review on-chain data, then take action in the markets. With Arkham Intel, you can see what top traders are buying and selling, and then trade directly on that information through Arkham Exchange. Arkham was built to make blockchains human-readable, simplifying data into meaningful insights for the average crypto user. To start using on-chain data as your edge, go to arkham.com.
Everybody knows macro is a dense topic with a whole lot of moving pieces, which is tough because if you want to be a successful investor, you need a solid understanding of macro. So that's why we've recently launched Milk Road Macro. It's a new newsletter from Milk Road where anyone can learn macro investing in a simple and digestible manner. So if you sometimes feel a little lost when it comes to macro, subscribe to the Milk Road Macro newsletter. We'll make it all just click.
As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Okay, speaking of narratives, one of them for the first few months of the administration was one of DOGE and austerity and narrowing the current account deficit and normalizing trade. And it felt like the peak of that all came forth in Liberation Day, and ever since we've seen a pretty substantial pivot. I don't remember the last time Treasury Chair Scott Bessent mentioned that he's eyeing up the 10-year and wants that lower. It's been a pretty significant narrative pivot towards, well, we're going to run the economy hot, we're going to outpace the debt. So you mentioned in interviews this idea that there's no going back to the Bidenomics era of 2021 to 2024, basically. But to me, it feels like ever since the I call it like the yippee level when Trump pivoted on a lot of these tariffs. It felt like ever since then we've
April
been
8th.
walking back. Yeah, he
April
blinked,
8th,
and then
the
it feels like we've been walking back towards that world. You said we can't go back, but it sort of feels like we're tiptoeing our way back there. How do you square that dynamic?
Well, I think a couple of things. First of all, in the bigger picture, what I've been arguing is Trump came in, he's got Stephen Mirren, who's his Council of Economic Advisors. I think you've interviewed him once or twice too. And he wrote, a paper right after Trump got elected about reorganizing the global trade. Within that paper was the Mar-a-Lago Accord. And really what this is about is the status quo that we saw prior to 2024. $7 trillion budgets, $2 trillion deficits, massive borrowing could not continue. It could not continue. We had to change something. And so that's what Trump is doing between tariffs, DOGE, the demand that Europe pay more for security, which they've agreed to. That was what I thought would be the most contentious issue, and it turned out to be the least contentious issue. You guys spend more on tanks and guns, and they said, fine, we'll spend more on tanks and guns. And to the tune of trillions of dollars is what they're at least committing to right now. And so all of this was meant to bring down the deficit, maybe make U.S. companies more competitive with foreign companies to encourage more job growth and opportunity within the United States. What I've said is, look, the way that Trump's gone about doing it, we could argue. The way he's done tariffs is wrong. Okay, fine. And so when I hear people getting all bent out of shape about tariffs, I understand why you are. And to some extent, I do too. But the implication is, would you just stop, just forget it, call it all off? Let's just go back to the way we were. We can't. Now, DOGE, I think you're right. DOGE has been a big disappointment, if not an outright failure. And we've all lost because of that. We are the losers because of DOGE, not Elon. And what I mean by that, we need to bring spending under control. Does anybody doubt that there is an enormous amount of wasteful spending in the government, and that we need to get the government to do the same thing with less money? And that's what DOGE was supposed to do. Now, he went about it all wrong and everything. He's the richest guy in the world. He's a force of nature. If he can't get DOGE to work, no one can get DOGE to work. Washington is just going to be a wasteful pile of money until the bond market stops funding it, the Liz Truss moment. So ultimately, at the end of the day, I just think that we all lost because DOGE wasn't done. You could either argue it wasn't done properly, or it's incapable of getting the swamp to change its opinion. Either way, I think we've all lost with that. So to answer your final question about tariffs, the biggest question about tariffs when it comes to Trump is, what is the goal of tariffs? There's two possible goals. Either to use them as a club or leverage to get somebody to do something. I want you to open your markets. I want you to, level the playing field with all your non-tariff barriers or something like that. And I'm going to threaten, or I want fentanyl to stop coming in from Mexico, and I'm going to threaten you with this economic sanction of tariffs unless you slow down the fentanyl flow or the migrant flow or whatever. So leverage is one thing. I think if Trump was to use tariffs as leverage, financial markets wouldn't have a problem with it. The other one is revenue, where Trump talks about the External Revenue Service. We could do away with the income tax because we're going to raise so much money from tariffs. Tariffs are a tax, and they are. And if he wants to use it as a way to raise trillions of dollars, a trillions of dollars tax increase, the market is going to view tariffs like a trillions of dollars tax increase and not like them at all. So the problem with Trump is, are they leverage or are they revenue? And he kind of says they're both in the same sentence. And that's where everybody gets confused. I don't know which way they're going. What I think he's been doing over the last, since April 8th, is that he's been leaning more towards leverage and less towards revenue. And the market has been calming down, saying, good, if you want to use this as a club to beat up the Europeans or to beat up the Chinese and say, get rid of your non-tariff barriers, get rid of the fentanyl flow from China to the US, or whatever happens to be the priority, spend more on defense if you're talking to Europe, fine. That's no problem with tariffs. But if you were talking about, we're going to have to create an external revenue service because we're going to raise trillions of dollars, that's where I think the problem came in. So since he's been moving more towards it being leverage, I think the markets have been breathing a little bit bigger sigh of relief.
Mm-hmm. Yeah, I feel like that brings up some important points, which is that I think this whole discussion dynamic is just, there's a huge lack of nuance around it where, obviously we've seen that the market will be pretty upset about a 30% effective tariff rate. Now, assuming that the current tariffs as they stand remain, we're sitting at around 15%. And it feels like that is something that, global supply chains can adjust to, and the economy can mostly digest with some residual impacts, higher inflation and that sort of thing too. But generally speaking, the sun will still rise the next day if we sit around there. But that goes against some of the other goals, which is, okay, we want to normalize the trade deficit. We want to, narrow that trade deficit. And so my question for you is, how do you think about some of the other approaches that can be taken for this? So, in that big, beautiful bill, we've seen some hints of what are looking like going after the capital account side of things, the capital account surplus, where they're starting to talk about taxing remittances outside of the US to other countries. And that dynamic, and then also the currency side of things, which is just the overvaluedness of the US dollar on a trade-weighted basis versus other countries. If they started to focus on, say, just an outright devaluation of the dollar, which is just, i.e., the Mar-a-Lago Accord that you've talked about, Stephen Moranis talked about, or at least in this paper talked about, what do you think about if? Do you see this potential for this pivot away from tariffs because it's like, oh crap, this is a mechanism that really hurts the consumer, whereas if I go after capital flows, that's just going after rich people. That's a lot more tenable to win a midterm election on.
Yeah, that brings up a couple of interesting points. Yeah, I don't think Trump is going to pivot away from tariffs. I think it's essential, part of his what he ran on. And I don't think the other thing too to keep in mind, and I got to get a little political here. Why did Trump win? And I mean both times. And I'll point it out in a very simple phrase. Trump was talking to working class and saying you lost your job, and he was proposing that he was going to get your job back. And famously, during the 2016 election, Obama, if he wasn't running, said, what's he going to do? Wave a magic wand? Those jobs are gone. And I think that a lot of working class people said, well, they've given up on us. At least he's going to try. If he fails, it's going to be no worse than them because they're not even going to try in the first place. And the point I'm bringing up is what I think are starting to understand is we all benefited from globalization. And there was a price. And that price was paid by the working class, the middle class. Their jobs were shipped overseas. 65% of the American public only gets a high school degree. 35% of the public goes to college. If you want to make a decent living with only a high school degree, unless you've got a good 3-point shot, it's probably going to be in heavy industry or in manufacturing or in construction. And a lot of those jobs were pushed overseas. Oh, but what about technology? Technology automated a lot of those jobs away. Yeah, that's true. But I think the inclusion of China in the WTO in 2000 accelerated that process. There was a natural process of automation was going to automate these jobs away. But then China came in with its heavy-handed trade practices, its cheap labor, and accelerated those jobs out of the United States. Net, the country was better off. But in the middle, there was a lot of people that paid a big price for that. And that's who Trump was going to. So what I'm trying to say in a long way is he ain't going to give up on tariffs. He may reorient them towards leverage as away from revenue as well. Now, the other thing you've been talking about too, it brings up an interesting point. And this kind of gets into Neil Howe fourth turning kind of stuff. Trump is talking about taxing the rich over 2.5 million, taxing capital accounts. And Grover Norquist runs the Tax Foundation, famously said, if Republicans don't cut taxes, what's the point of having a Republican Party? And now the Republicans are talking about raising taxes. And so you've got the Republicans talking about raising taxes. The Republicans are the party of peace. The Republicans are the party of trade barriers. Boy, that used to sound like the Democrats 15 years ago. The Democrats worry about billionaires losing money in the stock market. They're the party of war. Remember, that was Dick Cheney and the neocons 15 or 20 years ago. And, they're now the party of pushing back on tax increases. When the court came out last week and said that they struck down the tariffs as being unconstitutional, Kathy Hochul, a Democrat from New York, tweets out, "We saved the American public from this tax increase." Wait a minute. We are really upside down here when the Democrats are crowing that they're stopping a tax increase that the Republicans are trying to push through. So everything is upside down when it comes to our politics. I don't know. I guess what I'm trying to say is in 2025, I don't know what it means to be a Republican, and I don't know what it means to be a Democrat, because whatever you think a Democrat is supposed to do, that's probably what the Republicans are doing. Whatever you think a Republican's supposed to stand for, it's probably what the Democrats are standing for right now. And I'm speaking mainly about economic issues. So in respect, I think that, like I said, this is kind of fourth turning stuff when everything gets realigned. And I think that that's more in terms of where we are, which is, again, why I think we have to do something about deficits, debt, trying to bring everything back in line with the economy, because it is all very reminiscent of a fourth turning, that the status quo can't hold, and it's time to effect change in the economy.
What do you think is the role of monetary policy within this regime? Obviously, we've already hinted at this fact that, deferring rate cuts is just the baseline assumption on the short term. But I also want to hear about your opinions from like a pretty big picture of where the fiscal and the treasury side of things is largely running the show. The economy is roaring despite everybody calling for a recession every 6 to 8 months, like we've just seen in that JOLTS report today, and things are doing pretty well. And so obviously that basically sidelines the Fed on a short-term basis for them to just sit on their hands and do nothing. But, I think an institution that just sits on their hands and does nothing for 10 years isn't very tenable. So like where is the role of the Fed in all of this from a high level perspective?
Good question. And wherever the role of the Fed is, let me start by saying wherever the role of the Fed is now, it's going to change in May of next year, because one thing we know is Powell's not going to be the Fed chairman in 11 months because we could speculate whether it's going to be Kevin Warsh or somebody else, but it ain't going to be Jay Powell. And it's going to be a hand-picked successor by Donald Trump. And you would assume that will then usher in a change in the Fed in 11 months. Now, high level where the Fed is, I think they're kind of stuck in the same spot that we are with pre-COVID, post-COVID. Because let me pre-COVID, post-COVID, let me put this in a different term from monetary policy standpoint. Sidney Homer, Richard Sala wrote a book called A History of Interest Rates. Sidney Homer wrote the first edition in the 1950s. He was the director of research at Salomon Brothers back then. And it looks at 5,000 years of interest rate history. It goes back to 3000 BC. Yeah, there is data on interest rates going back that far. And 700 pages in the book, not one sentence in that book about negative interest rates, zero interest rates, or money printing. What we did between 2010 and 2022 was one of the most extreme monetary policy interest rate stories seen in human history, and we got 5,000 years of history to look back on. That era is not only over, it might be over for 5,000 years, but yet you hear a lot of people talking about, the Fed's going to print money and we're going to go back to zero. No, we did it one time in 5,000 years. We're done with it. Maybe, like I said, for 5,000 years. And one of the reasons we're done with it is we were able to get away with it because you had a run-in of 20 years of disinflation going into it. We don't have that. We have, like I said, we have a 4-year low in inflation. which I think is going to rebound in the second half of the year. But even with that 4-year low of inflation, it is higher than I'm talking about core, higher than any number seen from 2010 to 2022. It is still higher than any number. In other words, the highest inflation readings in the last 15 years have been the last 48 consecutive months, is basically what you've seen. And so we're not anywhere near that period of inflation. So we're not going to be anywhere near zero interest rates or money printing again. So the Fed has got to start looking at their tools and start to say, what kind of environment are we in? And I've said they need to remember what the 80s and 90s were like. It's going to be more like that. We've got term premiums going up. Again, same thing. The problem when everybody hyperventilates about term premium, Bill Dudley hyperventilated about it in an op-ed in Bloomberg yesterday, is, again, you're assuming that negative term premium we saw from 2015 to 2022 was normal. That was the most abnormal period that we have ever seen. The current level of term premiums today is getting back to normal. Real rates. People have hyperventilated real rates. That is, interest rates less inflation, positive 2%, positive 2.5%. It's a 15-year high. You're comparing it to that abnormal period before 2020, from 2010 to 2020, not to be repeated. 2% real rates is kind of normal. And so I think the Fed needs to kind of think about monetary policy within those pre-steps, but they don't. They keep letting the narrative or the conversation be, when's the next rate cut? How low are we going to go? When are we going to get back to 2% rates? I mean, I listened to the All In podcast, and for the last two meetings, for the last two podcasts, these guys spent 20 minutes basically saying, if I had to summarize their view, 0 is a normal interest rate for the funds rate. 2% is a normal interest rate for the 10-year note. Why aren't we there? Oh, something's wrong. The Fed's doing something wrong. The big, beautiful bill is pushing up rates or something. Something needs to be fixed so we could get back to 0 and 2. This is not, that era is over. And that, like I said, this is normal. And I think what the Fed needs to do is start thinking about it differently. Now, maybe, to go back to the way I started this, maybe that changes in 11 months when we get a new Fed chairman. Whether it is, the leader in the clubhouse right now is Kevin Warsh, but it's still 11 months away. Maybe somebody else will pop up between now and then. But like I said, at a minimum, you could say that in 11 months, it won't be a guy named Jay Powell. It'll be somebody else.
This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. They're the number one institutional staking provider by volume, managing over 250,000 nodes globally with over 70 points of presence. Their ISO 27001 certification and slashing risk protection means your assets and operations are backed by audited security standards and 24/7 monitoring. Whether you need secure nodes, MPC wallets, or staking at scale, Blockdaemon delivers enterprise-grade reliability and peace of mind. Visit blockdaemon.com to get started or book a call with their team today. Meet Arkham, the world's first crypto exchange powered by crypto intelligence. Arkham allows you to review on-chain data, see what the top traders are doing, and then act on that information with Arkham Exchange. They've made blockchain data human-readable with features like profilers, visualizers, and custom dashboards, making it useful and actionable for everyday crypto users. Arkham believes that transaction analysis, the study of wallet activity and fund flows, will match or even eclipse traditional technical and fundamental analysis. And in a cycle full of hacks, rugs, and scam-bundled launches, the best protection is knowing who's moving funds and where they're going. That's crypto intelligence, and that's what powers Arkham. Head to Arkham.com to start tracking wallets, following flows, and trading with an edge. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger secure chip and proprietary OS. Plus, With the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. I think that characterizes nicely why it's so unrealistic to bet on rate cuts. But I'm also curious, I want to get your view on how sympathetic you are to the risks of hikes as well, because within this regime that we're in, we saw the fastest rate hiking cycle in history and there was no recession and stocks went to all-time highs. And, there's a lot of, the MMT style argument is that when the Fed hikes rates with such high debt levels, that leads to huge interest payments to, people that own T-bills. And those people that own T-bills, they're in a 30-year fixed rate mortgage that's sitting at 2.5%. So their liabilities don't increase with Fed hikes. So how sympathetic are you to the idea that on the other side of things, if they were to hike rates further, that could actually increase inflation?
Yeah, I get that argument. I mean, you keep in mind that, bonds, we all tend to think about interest rates from whatever we happen to be. If you happen to be wealthy, you think of interest rates as an investment, right? I have my money in a bond fund, or I have my money in a money market fund, and how much income is it generating for me? If you're not as wealthy, you think of it as borrowing costs. How much do I have to pay to borrow the money to buy a house, to expand a business, or the like? And so the MMT argument, I am sympathetic to that argument, is that who owns, we got $29 trillion of debt, right? Who owns all that debt, or who owns a big bulk of that debt? It's the wealthy. So when interest rates go up, when interest rates go up, home prices in Palm Beach go up, because it's all the older wealthy people in Palm Beach. I don't mean Trump, I mean the other older wealthy people in Palm Beach, because they're living off that generated income. And so I get that argument that what the bond market is it's a transfer. It's a transfer to the wealthy because they buy the bonds. And I'll throw out another statistic to support that argument. Recently, the Retail Association, I forgot their exact name, is the National Association of Retailers or Federation of Retailers or something like that, said that 50% of all retail sales now in the United States is done by the top 10% of income, the most concentrated it has ever been. So one of the other things I think economists miss is I see pain and suffering, and I see people hurting and trying to make ends meet and clipping coupons and dealing with the difficulties of the economy. You're correct. But it only takes 10% of the population to keep GDP moving forward and holding the Fed from cutting rates. And that 10% is getting a lot of income from bonds. And so they're running to the store. As a matter of fact, like they said, the other statistic I saw recently was if you're in the top 1%, so think of a shopper in a mall. I know that's kind of a dated thing, but a shopper in a mall that's in the 1% of income, they will spend 11 times more than somebody in the bottom 50% of income. So 2 housewives in a mall that are in the top 1%, they are going to spend almost as much money as 25 people in the bottom 50% in that mall. And so if those people are living on that higher income, yeah, it's going to push some kind of a wealth effect down through. The difference with the bond market wealth effect is, of course, where does that money come from? Well, they're taking it from somebody else, repackaging it as interest rates and sending it on to the wealthy. Where at least with the stock market wealth effects, that's just a creation of wealth. Stock prices go up, and it's a creation of wealth. It's not as zero-summy. I know it's not purely zero-sum in the bond market, but it is a little bit more zero sum in the bond market than it is in the stock market. So I get that argument, but that's not necessarily, the final thought for you, that's not necessarily an argument for cutting rates. Because I want to go back to, remember I said that bonds are normal. One of the mistakes I see people make all the time is, why doesn't the Fed cut rates? Because then mortgage rates will go down, and then the housing market will get better, or whatever fill in the blank you want to say. The assumption in that is, interest rates are kind of a made-up thing, and let's just make them up at a lower level. let's just invent a number at a lower level. No, there is a fundamental to interest rates, and there is a normal for interest rates. Like when I went through with term premium and with real rates, that I think rates are normal at 5. Now, let me go back to 2022. What was the highest 10-year yield? Because I got that one memorized. What was the 10-year yield is at 450 right now. In 2022, the Fed raised rates from 0 to 4%, 20 rate hikes, 25 basis point rate hikes in the year. The inflation rate went to 9%. What was the highest 10-year yield for the entire calendar year? It's 4.22%. Where is it right now? It's at 4.5. Why is it higher now than anything we saw when the Fed was jacking rates 75 a meeting and we had 9% inflation? Because the fundamentals now support higher rates. Or to put it differently, when the Fed was hiking rates aggressively in 22, I as a bondholder could say they're on the case fighting inflation. I'm fine. I don't have to get that worked up. Yields went up because inflation was there, but they didn't soar. Actually, I would argue to you that if you look at the two instances that the Fed, stopped hiking rates, which was July of 23, a month or maybe 6 weeks later, yields were up over 100 basis points. And September 24, when they cut rates, they were up 120 basis points 4 months later. Every time the Fed gets dovish, rates go straight up. The fundamental in this market is you should be vigilant on inflation. We should have higher premiums on the markets. We should have higher interest rates. The minute you start talking about lower interest rates or follow through on it like you did in September of 24, then the bond market loses confidence in the Fed and rates go straight up. So I think the other thing we have to think about too is there is a fundamental. I know, the final way I say this is people say, well, the Fed can't raise rates because, the interest costs are so much. We pay $1.1 trillion in interest costs. They can't raise rates and they can't cause us to pay more interest. Again, you're assuming that we could just make up numbers. We could just make up a lower interest rate because interest costs are too high. It doesn't work that way. There's a fundamental rate for the market. And if the Fed wants to make up a wrong interest rate, too low, then the bond market vigilantes, they've kicked in July 23, they kicked in September 24, will kick in and drive its long-term rates even higher. They'll lose confidence in the bond market and everybody will pay in the form of higher interest rates, except the people in Boca, they'll just keep getting more interest income.
Yeah. Within this regime, it feels like there's very, very little upside to owning long bonds here for yields to go lower. And it feels like endless reasons for long bond yields to surge higher within this juncture. And this brings up to your point about bond vigilantes is, who's the sucker at the table that foots this bill of long bonds? And that seems to be the global question at hand right now. We've seen, bond yields in Japan are surging. We're seeing them everywhere right now. The question is at hand is who's going to foot this bill? And in the interim, Yellonomics of tilting issuance to the bills seems to be going global right now. We're starting to see hints of Japan taking up that strategy of weighting their issuance to bills. England as well is starting to hint at that. So obviously, for the past couple of years, that sucker at the table hasn't really been a sucker. It's been hedge funds that have been levering up on basis trades. It's been households who have seen a pretty nice, steady income stream. But overall, as we've established, the Fed is not going to be at that table to buy those long bonds. Foreign countries are, capital is going back into their own domestic bonds. They're not buying U.S. long bonds. So who's the next big, sucker at the table to foot this bill? There's obviously, it feels like the two routes that are being discussed right now are, one is stablecoin growth adoption and the other is bank deregulation to allow commercial banks to buy further. But how are you thinking about who's going to foot this bill next?
To start with the bigger picture, I'm going to push back about who's the sucker. The sucker's you and me. The sucker's everybody, because there's an old adage in the bond market. There are no bad bonds. There's only bad prices. The bond market will find, I think it's $14 trillion this year is what's expected globally to be raised by all sovereign governments. 2.5 of it, I think, is the US, and the rest of it is coming from everybody else, quite a bit. But it will get funded. Especially, let me just talk about the US. Especially the US, it will get funded. And how? Why and how? There will never be a credit problem in the US, despite what Moody's did. Why? Because they'll just take interest rates up and up and up and suck the life out of every other asset class. If you won't buy my bonds at 5, you'll buy them at 6. Nah, I will never sell my Mag 7 or my Bitcoin at 6. Fine. If I have to take them to 138%, and in order to get funded, I will take them to 138%. So they will always get funded, whatever that level happens to be. The problem is you don't want that to happen, because then when you start talking about valuations and discount rates and cap ratios in real estate, it just kills the entire economy, because those borrowing costs become punishingly high. So that's the reason why you want to see the government rein in its borrowing, because it will always find a buyer for those bonds. It's just, what interest rate will it take to clear? And you don't want that interest rate to be so punishingly high that it winds up killing the economy, which it further drives people in the bonds as well too, and away from risk assets. To your other point too, yeah, you're right. We've been playing games either with stablecoin legislation, or trying to bring stables in to be a buyer of treasury securities, and or bank regulation, which is the supplementary leverage ratio, which is the SLR. The only thing I'll say about the SLR, and I can kind of say the same thing about with stables too. I'll say it in terms of the SLR. When a bank buys a treasury bond, it needs to put some money aside, capital aside, in a supplementary leverage ratio in order to have a cushion against a loss. Well, they want to do away with that in order to make it more efficient capital-wise for a bank to buy. So if you buy $1 billion worth of bonds, you don't have to put some money into a capital account. You do have to put no money in a capital account by getting rid of the SLR. The only problem with that is that the bond market right now, the banks in total, according to the FDIC, are sitting on about a $500 billion unrealized loss. So you're going to say to the banks, I know you've got this giant loss. We're going to get rid of all these rules, so you can double down on that loss. They're not going to buy any more bonds. Now they might when the environment turns, it's more favorable for bonds if you get rid of the SLR. But they're not going to buy bonds, because they're looking at, they remember what happened to Silicon Valley Bank. And they're not going to wind up saying that, oh, we got these losses on bonds. Now they got rid of the SLR. Let's buy more of these things. No, I don't think they're going to do that. And the other issue I have is the problem with the stables right now is that, the interest rates that they're offering on some of the stable coins, the staking yields and stuff like that, it's not as high as a money market fund. So I can't imagine people are going to, they're going to look at stable coins and they're going to say, boy, I should get because remember, that's who they're competing with, right? A $1 NAV. A money market fund is a stable coin. It is a money in an instrument that has a $1 NAV every day. A stable coin is a $1 price every day. So what's it going to get for me to take my money out of a money market fund and put it in a stable? How about the stable staking yields, or whatever yields they're offering, is much higher than a money market fund? What I've seen, they're not. I mean,
No.
they're
Some of them are not at all. And then the Genius Bill's talking about having no staking at all.
Right. And so what is my advantage? So why would Warren Buffett take his $300 billion out of treasury bills, earning him 4 or 5%, $11 billion a year, and buy, all these stable coins to earn him zero? So that's the other issue that I see with a lot of these rules, that they're not going to really work. At the end of the day, the only thing that's going to drag people in the bond market is that it is attractive to the alternatives. Now, you would say, there might be an argument to be made that, the bond market's not very attractive. I'll give you two arguments here. One argument is, we know about the losses that the bond market had to take from 2020 to 2023, because you had to go from 0 to 5%. And that was an enormously painful process to do that. But now that we have a 5% coupon or 5% yield on bonds, the losses you will have in the bond market are going to be very limited. To give you an example, last year was a bad year in the bond market. It was still up 1%. This year is kind of a so-so year in the bond market. It's kind of up 2% this year right now. So it doesn't sound like much, but if as we go forward, the stock market is yielding, the stock market's returns are 0 to 1% right now, and we're already into June. Cash is going to return you around 4%. It competes with those other investments. And that's why I'm not surprised. If you look at the ETF flows, guess where the most of the money is going? It's going in the fixed income funds. And the reason it's going in the fixed income funds, bond funds, is because the argument is that the stock market, I've called it the 4, 5, 6 markets. Cash is going to return you 4, bonds are going to return you 5, stocks are going to return you 6. Bonds are going to return you 5 with less volatility. Stocks are going to return you 4, $1 NAV with no volatility. And so therefore, I think a lot of people are looking at their risk reward profiles and saying, you mean I can get most of the stock market's gains, not all of them, with a lot less volatility in the bond market, or half with no volatility in money markets? Thank you, I'll take that. What is being discounted in this market is the idea that there's going to be more back-to-back 20% years. I am one that doesn't think that that's what the market's going to do. Now, 6, not a bad number. It's just we're so used to 20, we think that 6% sounds like you're being bearish on the market, but you're actually not.
Yeah. I want to follow up on something you said at the beginning there, which is about, commercial banks don't want to buy long duration bonds because they got whacked by interest rate hikes and just saw huge unrealized losses on their books. But it feels like the world is all heading towards this direction of just huge amounts of bill issuance instead. And you can stuff the banks with bills because there's way less duration risk. They're not going to really lose out on those. And so it just sort of feels like this world is heading to this dynamic where every country is just issuing a shit ton of bills and avoiding long duration at all costs. And I'm just curious, when you look at historical precedents and, like that book you mentioned of 5,000 years of interest rates, like, has there been situations like this before where we see highly indebted countries shift almost entirely to bill issuance and just almost no long duration issuance? And where does that lead us? Is that how banana republics basically start?
Yeah, I mean, not that I'm aware of. I mean, what you're describing also is kind of an Operation Twist kind of thing. Because remember that what the original Operation Twist, which is where they were trying to twist the yield curve by changing the issuance, I mean, that was really started when it was still unclear what was the difference between the Fed and what was the difference between the Treasury. It was only in the 1950s that we had the Fed Treasury Accord to really define the difference between the two of them. The fiscal and monetary were kind of interlinked up until about 70 years ago, into the same type of thing. But I'll say this about all of these schemes, whether it is some kind of Operation Twist or it is these schemes, we've seen these schemes out of Australia recently, in some other countries where they've tried to, twist their yield curve around. So they all end badly. They all start and have some short to intermediate successes. We've twisted the yield curve. We've held down interest rates. Look at us. We're brilliant. But then they get to be like Australia or Japan with ending Operation Twist, or, their manipulation of 0% money. The bond market gets away from them, which is what's happening now. Yields soar, and they pay the price in big ways on the back end of it. So what I would argue is, if they're going to play this game with more bill issuance, and yes, they are, and less coupon issuance and the like, it will work for a while, and then it will end poorly. And the reason it will end poorly is this gets back to the Liz Truss moment. Remember, for those that are not familiar, she was the PM, the Prime Minister of the UK 3 years ago. They put out a budget called the mini budget. It was supposed to cut spending, cut taxes, increase spending, increase the deficit, and their bond market threw a fit, their gilt market threw a fit. Rates soared, forced them to not pass that bill, and then Liz Truss was eventually kicked out after 47 days as being the Prime Minister in the UK. All you're doing with bill issuance, if you're twisting the curve to hold down interest rates, is you're going to hold them down for a while. Governments are not going to be given any kind of signaling that they need to rein in their spending or their deficit spending. They're going to do more of it, and they're going to do more of it until eventually you can't fix it with a twist in the yield curve, and then the bonds markets blow up and you pay for it on the back end. They need to be given signals now that if you want to spend more money, it's going to cost you in terms of higher interest rates. So think twice about increasing spending. Think twice about deficit spending. But if the answer is that we want to do more spending, hey, central bank, hey, Treasury Department or finance minister, please make it so that we could get away with it. So then we could come back next year and do even more spending on top of the spending that we did this year. And then eventually we go too far and it winds up becoming bad.
Yeah, within this world right now where I think we can agree the long end is being suppressed by one form or another, but gold and Bitcoin are hitting new all-time highs every week right now. That must be a pretty good, if I was a policymaker and I was seeing that happen right now and something that's denominated in the US dollar, I would see that as a red flag of spending. So yeah, like how do you think about those monetary hedges like Bitcoin and gold within this juncture?
Oh yeah, I think it's the same thing. It is a red flag for kind of the same reasons, right? First of all, they're as far as asset classes go, they're among the smallest asset classes. So it takes the least amount of money to push them up relative to pushing around stock markets or bond markets, or money market funds or real estate or some of the other larger asset classes. And they have to be looking at what that definitely means. Now, crypto is kind of an interesting story, right? Because I think within the central bank community, they see, recently 110,000 on Bitcoin. And the answer is, do they think of it as a loss of confidence in the US, kind of like $3,400 gold would be? Is that a loss of confidence or a questioning of the confidence of the financial system? No, I don't think they do at the central banks. I think they look at it as a speculative vehicle. And they think of it as more like GameStop in 2021, and that there's too many, and I've been accused of talking about this online. There's too many degens in the world, and they're going crazy in these markets, and that's the real problem is too much speculative activity. That's the way they view it. Now, which one is it? I think it's kind of both at the same time, right? That there are some people that are going into it because they think that, they want to have an alternative to the current financial system. Look, that's why I own crypto and cold storage. And then there's others that are, racing into it because it's all number go up. And that's the speculative aspect of what you're looking at right now. And that they want to, and so I think that there's a real struggle as to what that means. And as far as gold goes, you could argue, because I've asked central bankers this, isn't gold like an indictment of policy and an indictment where we are? And they kind of like, yeah, but it's very small. It doesn't take a lot of money. It's not representative of anything but a small cohort of thinking in the market. That might be technically true, but be careful of thinking that way because that's how you get yourself in trouble.
Yeah,
you should be taking it. Yeah, you should be taking it a little bit more seriously than that.
Yeah, 100%. Okay, so just to round out our conversation here on asset classes. So you have your 4, 5, 6 framework. You have gold and Bitcoin that do pretty well as this combination of speculative behavior and questioning of the resilience of the US dollar reserve complex. My last question for you around asset classes is this idea of capital going back home to domestic countries. So we hinted at this a little bit in terms of, there's the bond side of things where, for, say just your average Japanese citizen, it's a lot more accretive for them to own their domestic bonds now that actually earn something as opposed to owning the U.S. bond yields on a hedge basis. So there's that side of things. And then I'm also curious about your take on the equity side of things in other countries and that capital going back home. There's been a lot of interesting headlines where you've seen, it feels like a lot of policymakers are trying to repatriate capital back home. So yeah, where does that dynamic sit within all of this?
So the yen carry trade, to start with that one, right? For everybody, that's that Japanese banks were, for decades, were offering you zero money. So you borrow a bunch of money in Japan at zero and you buy something that has a higher yield. And, that was the carry trade, financing it at zero in Japan, buying something that yields a lot more. In order to do the trade right, you have to take the currency risk. You can't really hedge. You can hedge, but most of the yield differential disappears with a hedge. But you take the currency risk. Furthermore, the yen carry trade, you would buy treasuries, but you would really buy, EM debt. The example is 3-month bills in Mexico. because they're yielding around 10 or 11%, or were recently yielding around 10 or 11. They're closer to 9. So that was always the quintessential yen carry trade. Borrow 0, buy 3-month Mexican bills. As long as the peso yen exchange rate doesn't depreciate by 10%, you make money. If it doesn't depreciate at all, you make 10%. And as a matter of fact, there is a total return index on that trade, right? 0 in Japan, buying Mexican pesos, taking the currency risk. It's actually outperformed them until about 4 months ago. It actually outperformed the Mag 7 for the last 5 years.
I believe it.
That's how profitable that trade has been. That is being called into question and being reversed because there's risk. We've seen those markets. Like I said, it was profitable till 4 months ago. It's not profitable now. And then the Japanese are starting to look around and go, why do we go overseas to get yield when we're starting to get it here in Japan? And I don't have to take any currency risk if I buy it here. So that money is not leaving Japan and going anywhere else. Why is that important for us? The Japanese are the largest treasury buyer as a country in the world. They're larger. Number 2 is actually the UK now, which is a lot of the UK arms of American banks. And number 3 is China. But number 1 is Japan. So if they're now starting to say, yeah, we don't need to own $1 trillion worth of treasuries, we could just buy JGBs because they're starting to give us yield, it's another loss of a buyer. So that is a big concern. And it has been since the yen carry trade started getting wobbly late last summer. And I think it's going to continue to be a concern, which is why I think interest rates will continue to move higher. Stocks. I got a different view on stocks. I mean, people use that phrase, the loss of American exceptionalism. That is basically an insult to the country. And I don't think a lot of people understand what you're saying there. That you're saying the loss of American exceptionalism is just a fancy way of saying that the American government, the American country is going to cease to exist. Oh, I don't mean it that way. Well, that's what it means. That's what it means. And I think it was coined by a bunch of salty Europeans that don't like the word exceptionalism because that was that word came from de Tocqueville 200 years ago. And what it meant was unique, different, a one-of-a-kind experiment. That's what exceptionalism meant. Today, we think it's a condescending term to mean I'm superior to you. And so that's why people rail against that term, but they shouldn't because they're using a modern definition for an old term. And so when they do say the loss of American exceptionalism, they're just saying the country's going to cease to exist. So that's my little diatribe against that. But I think it's more fundamental than just the loss of American exceptionalism. The forward PE on the U.S. stock market, the S&P 500 is, I looked it up this morning, is 22. That is a very high number over the last couple of years. Forward PE on European stocks is around 12. Now, you could argue that European stocks are cheap for a reason. Their markets have underperformed. Their economies have underperformed. They don't have as many dynamic companies as the U.S. does. We have the Mag 7. They have none of them right now. What do they got? Spotify in Sweden and a couple of other things. That they don't have a whole lot that they could really look at that would be competing within the Silicon Valley venture. So think about it this way. At a 22 PE with rising interest rates, you need almost everything to go right in order for the stock market to keep moving forward. But if you're going to buy Europe at a 12 PE with stable interest rates, or maybe slightly rising interest rates, a little bit less than ours or lower than ours, you only need a few things to go right in order for it to work. And so I think the rotation is just out of expensive stocks and into cheap stocks, because we're in this period where Trump is doing all this stuff with tariffs and there's all this borrowing and all of these crazy things are going on, not to mention geopolitical stresses between Russia, Ukraine, Gaza, Israel, Pakistan, India. And I need everything to go right to own a 22 market. Maybe I'll buy the 12 market and just wonder if I'll get a couple things to go right and have that work out. I think that's why we're seeing this rotation, not this end of American exceptionalism, a rejection of the policies of Trump, or I'm sure there's some of that, but I don't think it's a driving force behind it. It's just out of expensive stocks and into cheap stocks in a period of great uncertainty. I think that's all that really is.
All right, Jim, we covered a lot there. Really enjoyed that. Where can folks go if they want to see your work?
Two things. We do, my day job forever and ever has been the research business, biancoresearch.com. I'm active on social media at Bianco Research on YouTube and on Twitter X, and at Jim Bianco on LinkedIn. We also run an actively managed fixed income ETF with our partners at Wisdom Tree. It's got its own website called biancoadvisors.com, or this ticker symbol is WTBN, Wisdom Tree, Bianco, Nancy. It is a total return fixed income fund. You can learn more about it at biancoadvisors.com.
Awesome. Well, thanks for joining, Jim. That was overdue and always a pleasure.
Thank you.